Hey everyone, in today's video, I'm going to be going through my $209,000 Wealthsimple stock portfolio. In this video, I'm going to be sharing what positions I currently have in this portfolio, but I'll also be talking about some of the recent moves I've been making in this portfolio and what I'm looking to do with this portfolio moving forward as well. So I will just jump right into it. As I get into it, if you like this type of content, be sure to just give this video a big thumbs up. It really does help me with the YouTube algorithm, and I do appreciate it. I'll start on the Canadian side of my portfolio. So I'm up about 4% all time. It's actually been trailing down. In the last 3 months, I'm down about 4%, almost $6,000 on the Canadian side of my portfolio. Going into the stocks I currently hold, Allied Properties is a Canadian office REIT there. It's been dragged down with just the overall sentiment around office space globally, but also in Canada, paired with interest rates going high, have really just cramped their ability to grow their profitability there. A&W Revenue Income Fund is actually one that I've been buying a bit more recently. Going at the 1 year, this one's dipped about 15%. But with that being said, they're still growing their same-store sales growth, their restaurant count, their royalty income year over year. So it's really interesting that I'm getting a much better price for a higher payout than I was or than shareholders were getting a year from now. So this is one of those stocks that I know it's impacted by interest rates, but I feel like it's at a decent valuation here. Not a stock that I want to go in absolutely huge on or make like a top position, but I do have a pretty good amount of money in it. I've put in over $18,000. Right now I'm about 17,500 into it from a market value perspective, down over $1,000. But I am getting a 5.7% dividend yield, gets paid out on a monthly basis. The way I look at this one is while you can buy other quick service restaurant companies like Yum Brands or McDonald's for 25 to 30 times earnings, I'm getting this one at a 16 times, and I'm actually de-risking that return by getting it on a monthly basis paid back to me in distribution. So this is one that I think is a defensive company that will still do well no matter what the economic landscape is. And I'm getting almost a 6% dividend yield starting to own it. So this is one that I like, and I'll probably nibble a bit more on. I've bought 5 shares here recently, so nothing major, but just an example of my appetite to invest more into this stock here. Continuing to go down the list, another one that I haven't been investing in recently, but I'm looking to potentially start adding to if it doesn't move up, is Scotiabank. So in this account here, I only have 35 shares, down about 4%. But overall, Scotiabank is actually down 16% over the last 5 years. I wish I had a long-term chart in Wealthsimple so you can just see how well this company's actually done much longer term. But these are companies that are essentially in an oligopoly, really hard for them to get taken down or have any significant pressure on their equity that would deem a potential bankruptcy or anything like that. They've been operating for hundreds of years. They've increased their dividend almost 50 years straight. And the starting dividend on Bank of Nova Scotia right now is almost 6.5%, trading at a 9 times trailing yield and 8 times forward yield. So on this stock here, I feel like the risk reward, given the historical background on this company and the Canadian banking sector overall, is attractive. And I like the 6.5% starting yield for a company in this space, under 10 times PE, so still plenty profitable as well. So in the banking space, TD Bank's my favorite Canadian bank stock, but I think Bank of Nova Scotia is still at a super enticing valuation to add shares here. Continue to go down. Canadian Apartment REIT. This is one that I like holding in my portfolio. They're the largest owner of residential rental properties in Canada. See at $50 right on the nose there in terms of share price. So paying just under a 3% yield, $8.5 billion market cap. They do $400 to $450 million of funds from operations. So trading right around a 20 times PE or funds from operation multiple here. Not one that I'm adding to necessarily, but I do like holding, I think it looks like, yeah, I have about 100 shares on the dot there. Cash is a position that I've talked about before, a really boring position, just pretty much where I hold my cash just to make sure I'm getting some yield and distribution off of it. So you see throughout the month, the value of the ETF goes up as it gets closer to the high interest distribution payment. It's currently yielding over 5% a year, gets paid out monthly. I have about $15,000 in this one. So very low risk position. I'm just getting about $60 a month in dividends or distributions by holding it there. And I just like having that $15,000 cash balance in case the market really does crash in a big way or something like that. CN Rail, this is one that I haven't really been adding to too much lately, but it is probably my favorite stock in the Canadian market. Super good track record. They buy back lots of shares. They also keep expanding their moat. They have such a wide moat in this space. It's really not going to be any new railroad companies that jump up or sneak up from under them. So I'm really excited for the kinds of returns and shareholder value CN Rail and other rails can create long term. Looking at this company, it's trading right around $100 billion market cap, 20 times multiple. You get a 2% dividend yield, but they increased the dividend every year since they went public in the 90s. Another interesting thing about CN Rail is it was actually owned by the government. It was a crown corporation in the 90s, and they sold it to raise some money. I think it provides such an awesome opportunity for public investors to own a piece of this company. I think realistically, this is something that should be like a prized possession by the government to own the ability to move goods all over the country, almost in a monopolistic fashion. So I think it was a blessing in disguise when the government offloaded this company, and I'm happy to own it. I don't own a ton of it here. Well, a decent position, $12,000. But I own CN Rail on almost every single one of my accounts. So it is actually, I believe, my biggest overall position that I hold in one particular stock. Going down the list a bit more, Canadian Utilities. This is, I believe, one of the longest dividend increasing companies in Canada. They've increased their dividend for over 50 straight years, but they've kind of gotten to the point where they're only increasing their dividend like 1% or 2% a year, essentially a penny. You see here that they have their dividend yield. It says 7%. That looks a bit high to me. I believe it was 5% when I bought in, and now the stock's trading about 10-15% lower. So if they had a raise in there, maybe closer to 6%. I wouldn't trust that yield without double checking. Trading at about 14 times earnings, $8 billion market cap, and they just have a lot of different utility assets. I believe they also have some global exposure in their company in Australia and other areas of the world where they have some business coming in. But I just really like the 50-year track record, not only of just paying their dividends, but increasing them at a reasonable starting yield. Diversified Royalty Corp. This is one that I've added to the portfolio over the last year. It's actually done pretty well, up about 5% in the last year. I recently added a bit more on this one, which is why I weighted myself up. But it's paying over an 8% dividend yield. Diversified Royalty Corp owns trademarks like Mr. Lube, Sudden Realty, a couple other businesses like Oxford Learning Centers, and so on and so forth. They own the Air Miles brand. So anytime any commerce occurs with these businesses in terms of revenue generation and realization, this company's getting a slice off the top, similar to A&W Royalty Fund and other types of royalty funds. And you're getting that paid out to you on a monthly basis, 8% per annum. So pretty good cash flow opportunity on this company here. Continuing to go down, Fortis is a very similar company to Canadian Utilities. They operate in primarily the regulated utility space. So they have fixed contracts and things like that. Given the nature of essentially owning a fixed income stream where they know exactly how much money they're going to make, this company is very susceptible to changes in interest rates because it's essentially just a long-term bond at 4%, where you know you're going to get about a 5 or 6% dividend increase every year. So this is one that as interest rates go up, more money flows out of Fortis into higher paying treasury bills and things like that. But it's one that I've owned for a while, and I plan to continue holding it for the long term. Continuing to go down, I'm just going to skim over lots of these covered call ETFs, but I own HDIF, I own Huddle. These both are Harvest covered call ETFs. So they own securities in certain industries, but then also write covered calls, so selling the premiums on them. So in addition to the dividends from those securities, you're also getting the payouts of the covered calls. So essentially, you're selling your upside, but you're getting a lot more dividend yield today from these. So both of these pay me 7, 8, 9%, somewhere in that range. Continuing the trend of royalty companies, Keg Royalty, similar to A&W, similar to Diversified Royalty Corp, they really just get a slice off of the top of any dollar spent at any keg restaurant in Canada, and then it gets paid out to me at the end of each month. On the current value, it's paying out about a 7.5% dividend here. So a pretty juicy yield I'm getting on a monthly basis to reinvest in other things in my portfolio as well. Life, this is another covered call ETF owning high yielding healthcare stocks. Think companies like Pfizer, GSK, AbbVie. This ETF owns all of those companies, buys covered calls on them, and pays me out a pretty nice dividend as well. Northwest Healthcare is a REIT. I'm not going to talk about it too much because it's actually my worst performing stock, and I've been meaning to look into it a bit more to talk about it a bit more intelligently. But at the risk of misrepresenting it, I'll just take a pass on it for now. The one thing about it, it does pay almost a 12% dividend at current levels. I know there's a lot of concern on if that's sustainable though. So watch out if you're just looking at the dividend yield on that one. Restaurant Brands International, this is a company that one of the companies I'm up almost the most in this account, up 30%, over $2,500 here. You can see that they've ended up executing really well over the last little bit. They brought on, I believe, Patrick Doyle, who was the ex-CEO of Domino's Pizza, as a chair, and that really got people excited just because how successful he was scaling internationally for Domino's and the opportunity that businesses like Popeyes, Tim Hortons have in scaling more internationally. This company also owns Burger King, but that already has pretty strong international scale. Going on past restaurant brands, Rogers Communication. This is one that's actually dipped a lot over the last month. After reporting earnings, they're down about 8%, despite the Shaw acquisition closing. See here, they pay over a 3.5% dividend yield, which is definitely nice to have. This is one that I'm going to maybe give it another quarter of earnings, but as long as the business stabilizes, they start realizing more and more synergies, I wouldn't mind buying more Rogers in my portfolio. Good dividend company, good track record. Once again, it's essentially a Canadian oligopoly again. I'm a bit concerned on what their exposure to cable may look like or how that may decelerate like we're seeing in the US. But so far, their cable revenues over the last few years have not seen the same fate or not experienced the same fate. So that's just one thing I'm keeping an eye on. Rogers is the #1 wireless company in Canada, so the vast majority of their money is coming from cell phone plans and stuff like that, which I think is safe. They're also selling internet packages, etc. So they're not completely dependent on that cable revenue, but it is interesting to see how that develops in Canada versus the US. Rogers, as a fun fact, also owns the Toronto Blue Jays and about 40% of Maple Leaf Sports Entertainment, which owns the Leafs, the Raptors, other sports assets. So they're in that sphere as well. Going into TD. So TD is a stock that I actually bought 60 shares of this stock today. It's not showing me on this account here, but I went from 35 to 95 shares. Essentially what I did with TD, and I got it from some feedback in the comments on prior videos, I'm just being careful on how many companies I have in this portfolio with non-eligible dividends because of the tax rate that I'd have to end up paying at the end of the year. So I've been looking into it a bit more, and I did a bit of a switcheroo. I took the 60 shares I owned of TD in my RSP today, and I actually sold them, and I used that money to buy RioCan shares, and I sold all those RioCan shares I had in my Wealthsimple account and put it into TD. So The net impact to my overall portfolio was nothing. I owned the same amount of RioCan, I owned the same amount of TD Bank, but now instead of having some non-eligible dividends in an unregistered account like I had before with RioCan, now all of those shares are moved over into my RRSP, and I moved eligible dividends from my RSP into an unregistered account since I'd get a bit more of a tax credit on those dividends. So just some movement, but nothing big for me overall. It was just a bit of a pivot. ZDI is a international dividend ETF. They own a lot of blue chip companies. Think like Nestle, Estee Lauder, stuff like that. So they have a lot of European exposure. You also get some Japanese exposure too, and some Australian exposure, which is nice to have. The stock's done well for me just because it dipped pretty heavily on the Russia-Ukraine issue that's going on. That kind of scared lots of the European stock market. But I'm even seeing the distribution tick up. I think they increased their distribution yield by about 10%, which is nice to have. The overall yield here is over 4%, which is a nice starting yield for blue chip dividend stocks. Hopefully over time you get a raise. The one thing about this ETF is they do have a management fee of like 0.55%, which is on the higher end for a company that's not doing anything active like covered call ETFs. And on the topic of covered call ETFs, the last two covered call ETFs I have are actually here as well. ZWB is a covered call ETF for Canadian banks and financial companies. I believe they also own like the insurance companies, Manulife, Sun Life. And ZWC is a covered call ETF for the entire Canadian high dividend paying stock market. So think companies like Bell, think companies like Pembina, Enbridge, Suncor. Lots of those energy and other types of companies are in here. You can see over the last 5 years, the company's actually down 15%, but they've probably gone about 40 to 50% in dividend payouts from that. So all in all, it's definitely not one that you get rich on, but you get a lot of cash flow today from this stock, currently trading at about a 7% dividend yield here. Okay, so that was my Canadian side of my portfolio. I'm going to make a pivot to the US side here. Looking at the US side overall, up about 17% all time. And you can see what's interesting is I was actually flat earlier this year, even down earlier this year in terms of unrealized gains. And now I'm up 17%. So this has all happened in the last 6, 7, 8 months. Going stock by stock here, you kind of see where lots of it's coming from. Google up about 25% in this account. That one was one that had a lot of weakness earlier in the year. Coca-Cola is a stock that, wow, pretty big down day today, but is a stock that I've recently added to my portfolio. I've been buying it aggressively, currently have 150 shares of it. This is one that I would be open to continuing to build if I got in at the right price. I'm using kind of $60 as a benchmark for how I think Coca-Cola should be valued. So as I get closer to $60 or under $60, I may start working more towards a 200 share position here, especially if I get down into the 50s, like mid 50s or lower. I definitely start building out a bigger position here. I just love Coca-Cola's relatively low price point. I don't think it'll be overly impacted by any consumer pressure, just because we're talking about a couple bucks here, a couple bucks there. I also love their global exposure. That's probably the number one reason I'm in the stock. They're such a global company. They're such a great brand, and they own so many great brands that are known around the world. I think that really feeds pricing power, feeds staying power. So I really like that aspect of their business. And I believe those attributes really coincide well with having a strong dividend, 3% starting yield that has been increased every year for over 50 years now, I think. So I can sleep well at night knowing I'm probably going to get that 3%. And every year, my yield on cost will probably go higher and higher from buying in now, given that they tend to increase every year. Continuing to go through some names here. McDonald's is a stock that I own in a couple other accounts, up 25% in this account, but pretty small position overall. It's dipped a bit here the last few days, I guess, with Coca-Cola and some of the other CPG type stocks. Very similar sentiment. I think McDonald's is a great company, super defensive, think they'll do well in any environment, but they are trading very expensive, about 28 times earnings, I believe. Meta is a stock that I'm up huge on, almost 200% here. I actually exceeded 200% a couple days ago, so it must be falling down a bit. But I only have 11 shares in this particular account, and I'm up $2,300 on my total position currently of $3,400. This company's trading at an $800 billion market cap. I can go on all day about Meta and how I feel about their core business, and like Reality Labs being something that I've been very frustrated with the spend there. But overall, I'm just gonna leave it for this video and can circle back in another video. Especially don't like hammering them when they've delivered over 80% returns year to date. Okay, Microsoft here up 32%. Really strong company, kind of firing on all cylinders. Looks like they're going to close their Activision Blizzard deal, which will be great. In addition to that, they've kind of gotten at least the perception of being on the front lines of the integration of AI into their tools and just being thought leaders in that space. And I think the market's really rewarded them for that push. But they also have a lot of just great core businesses, whether that's Office 365 as it stands, LinkedIn, Xbox gaming, etc. So really like owning this company. They have a great cloud business as well, trading at about 32, 33 times. Hopefully will be under 30 times next year if they grow at the pace they've been growing. Not one I'm looking to add to. Same with Meta or McDonald's, but all really solid companies that I don't mind holding in my portfolio. Okay, going to Realty Income here. Along with Coca-Cola, Realty Income's the other stock I've recently been adding. Got it up to 150 shares here in my US account. Overall, I'm actually down about 250 bucks, but I have been getting a nice monthly dividend yield around 40, 45 US dollars, I believe, which has been great. Looking at this stock long term, you see it crashed after the pandemic, slowly kind of climbed its way back up, but it's in a bit of a rut. In the last year, the stock's down almost 20%, with lots of the other REITs as interest rates have been staying very high and not really coming down, and lots of other implications on their business from a macro standpoint. But overall, I think Realty Income will do really well long term. I like how they're in all 50 or 52 states, and they also expanded into Europe. Like they're in Italy, they're in Spain. They have 10% of their NOI coming from the UK as well. So I like how diversified the business is. I probably won't be adding any more here, at least for a while. I'll cash some dividend checks, focus in some other areas away from real estate that I can summarize at the end. But I really like that I built this into almost a $10,000 USD position for me. And just wrapping up with the last couple stocks here. P&G, very similar thoughts to McDonald's. Good business. I like the global aspect to it. Up about 15% on this one, but not one I'm really looking to add to too much more in this account. AT&T, this is one that has been one of my worst performing stocks. I've held it for a few years now. I've been getting great dividends, currently almost an 8% dividend, even though they recently cut it when they spun out Warner Brothers. But this is one that just trades for such a cheap multiple. They forecasted $16 billion of free cash flow this year, currently trading at $100 billion. So they're trading at about 6 to 7 times their free cash flow. That means they're getting a free cash flow yield of about 15%, paying out half of it on a dividend. Hopefully they're using the other $8 billion, give or take, to pay down debt, invest in growth opportunities. But it seems like the sentiment on these companies in the US are so much worse than in Canada. I know they had to invest a ton of capex in building out their networks and 5G, and it's a lot more competitive in the US than it is in Canada with all the players, T-Mobile, Verizon, etc., all kind of knife to the throat on trying to steal users from each other. But I just feel like at a 15% free cash flow yield, at some point the net present value of these companies, given how much money they're generating, are higher than what the market's trading. I may be wrong. The market's proven me wrong over the last few years, but I think this one hopefully has a brighter future than lots of others are pinning them down for. And then lastly is Visa. Visa is one of my favorite stocks. I mentioned CN Rail is probably my favorite Canadian stock. Visa is probably my favorite US stock right now that I own. The company's ripped up pretty decently this year, 12% in the last year, but closer to 20% fiscal year to date. Looking at this company, they're trading at almost a $500 billion market cap, 30 or low 30 times PE, but it looks like over the medium term, over the next couple of years, I'm hopeful that this one will get down to closer to 26-ish times, 25 times price to earnings ratio with some growth that we've seen them consistently deliver over the last decade. You're getting a tiny dividend yield here. It will go up every year. They tend to increase it double digits year in, year out. But even with a 10% increase, it goes 0.72 to 0.8%. So the dividend's not a big part of the capital return. They do buy tons of shares back though. So that's where you're really gaining as an investor in terms of capital being returned to you from the operation. I love how Visa is essentially just royalty on the global economy as people are paying for things and traveling around the world. They're just getting their couple percent on each payment. In addition to that, I think they'll also just benefit from cash to card conversions in emerging and developing markets. So love this business. Don't think it trades at a very expensive multiple for what it is. And it's one that I'm looking at building a bit more in my portfolio as well. So just as a summary, some stocks that I've been buying recently: Coca-Cola, Realty Income, A&W Royalty Corp on the Canadian side. And then stocks that I'm looking at adding to, just really looking to add stocks that add some more diversification globally and geographically to my portfolio. So Visa is definitely one that fits that bill. Coca-Cola at the right valuation is also one that I'm keeping an eye on. And then lastly, the market's really been running up this year, especially lately as well. So cash is one that I do not mind holding on more to, especially when it's yielding over 5% for me, giving me a nice monthly distribution as well. Makes me feel good. So if I don't have opportunities, maybe moving my cash position from $15,000 to $20,000 or something like that is definitely not out of the cards too, depending on how those stocks I just mentioned prior are trading and if there's any other opportunities or not in the market. So that's a quick review of my $209,000 stock portfolio. I hope you guys liked me going through these stocks. If you did, be sure to give this video a big thumbs up. Consider subscribing to the channel if you haven't already, and would love to hear any thoughts you have on any of the stocks I'm showing in my portfolio in the comments. Thank you guys for watching, and I'll see you guys in the next one.